Good morning.
Morning.
Hey, we're just going to go over quickly the report that I wrote at the end of the day yesterday. Report from May 24th. The heading of the report is "A bird in the hand is worth two in the bush." How many of you have never heard of that before? You never heard that before?
Not really.
Wow! I thought everyone had heard that. It is one of the oldest and best known proverbs. And it's well known because it really applies to so many different situations. I know I've used it many times myself throughout my 68 years. It's been something that really had application, but it particularly has application to us now within the energy markets. So that's what I was trying to use, a proverb that most people were aware of, and see how it does apply to today. So in today's report, I'll explain how this old proverb does pertain to natural gas and electricity hedges now, that it is better to obtain a hedge now than wait later on. It's better to have that bird in the hand right now than hope for two later on. That's the whole premise. Now, I mentioned in the last report, I had talked about the fact that the pullback was a buying opportunity, and for long-term hedges, those that were risk adverse, it was in their best interest to secure long-term hedges. And I went through in some detail why that was the case. Now, since then, the market did move higher, and over the last month, it's been consolidating. Now, that's a term that I used, consolidation. Does anyone not know what that means? Come on, be honest. You all know what consolidation means. Well, I'll be redundant then. I'll just repeat
Jeff,
it.
what's it mean?
Consolidation.
Ooh, me or Jeff?
Yeah, when you group everything together.
Yeah, when pricing starts to consolidate within a relatively small range. What I've seen over the years is that when a market starts consolidating, when it starts compressing within a small range, it's preparing for a breakout, one direction or the other. In the report, I mentioned that, well, which way is it going to go? There's actually arguments that could be based to support the market going higher, but there's also arguments that could be developed why the market could have a pullback. And I talk about that based on the fundamentals, which I've been talking about over the last few months, that we have structural deficits right now. The structural deficit is based on increased exports to Mexico and also with liquefied natural gas. And also, by the way, the production of gas has not gone up as quickly as they thought would have gone up domestically. The major producers are still not producing as much gas as people thought they should be right now or would be right now. So we don't have as much supply as we thought. Demand is going up, so we have a structural deficit right now. Now, that structural deficit is going to support higher prices. It's just supply and demand. Those are fundamentals. And we do believe pricing is going to, because of that support that's there with that deficit, that the pricing is going to tend to move higher as we go throughout this year and into next year. There's also, I'll be developing reports that will be talking about increased demand in 2018, which is going to be significant, which is going to also continue to support higher pricing. But in the near term, over the next 6 months, next 12 months, we have a structural deficit that's expected to remain in place that's going to support pricing. But in the short term, we have technical factor. The technical factor is a lot of people know this. A lot of the speculators have been following other reports along with ours, and they can see that this is going to take place. Pricing is going to go higher. So if you believe something, you're going to put your money based on what you believe. So a lot of speculators right now are long the market. What do I mean when I say long the market? You're either long the market or you're short the market. If you're long the market, you've bought positions believing the market is going to go higher. You're betting the market is going to go higher. If you're short a market, you are believing the market is going to go down. Another term is when you're long the market, you're bullish. When you're short the market, you're bearish. Right now, there's a lot of bullish speculators. They believe pricing is going to go higher. And because there's so many of them, quite often the market will do what will be the most displeasing to the most people. That's why contrarians tend to do well. You see what most people believe, and sometimes in the short term, there's going to be a counter move. Now, it's also possible that counter move could be triggered by the big boys. See, the pricing is relatively high right now. When I say relatively high, relative to 2018, 2019, 2020, and I'm going to touch on that. But because the pricing is high near term, it would be to some's best interest to sell those high-priced near-term positions that they bought 6 months ago, a year ago, and start rolling them over into the further out months. So, right now, we have an argument fundamentally, pricing is going to go higher, but technically we could have a pullback. So, looking at it superficially, someone might say, well, I should just wait. Why should I buy now, since there's a good chance we'll have a pullback? Well, it's a simple reason. You may have that pullback, but it may not help you. It may not be in your best interest to wait. The bird in the hand still may be in your best interest and not try to get the two in the bush. You know why? If you read the report, I explained that over the years I've seen many instances when the nearby contracts were higher than the further out contracts, which the term is what, Dan?
Backwardation.
Backwardation. The market is in severe backwardation right now. And I give those pricing. Right now, near term, it's around 3.25. When you get out into 2018, April 2018, you're 294. April 2019, 272. April 2020, 268. That's the bird in the hand. Right now, you have an opportunity to buy markets in the forward, buy gas and electricity in the forward markets at much lower pricing than it is right now. That's the bird in the hand. Now, the big boys understand this. So there may be a pullback where they're going to be selling their nearbys and rolling it into the far outs. Well, if you're waiting for the market to pull back, you may see it nearbys pull back, but the further out months will go up. So when you're hedging your account, you're going to see the market go down, but you're not going to see it reflected within the price of your gas and within the price of your electricity. Make sense?
Mm-hmm. Yep.
Now, some of you are saying yes, but I've said a lot. I send over the notes. It's all in summary. Read through it. Make sure it does make sense to you. But not only that it makes sense to you, but that you can speak to your clients with belief. See, conviction and belief is vital. I believe it's in our best interest right now, my client's best interest, to secure long-term hedges. I believe it because a bird in the hand right now, those low pricing for 2018, 2019, 2020 is there for the taking. Will it be there a month from now, 2 months from now? I don't know. I suspect not. I suspect those far out months are going to start going up. I think the nearbys may have a correction, but the far out months are going to continue to go higher. Any questions? Okay, share this with your clients.